If silver touches $80 tonight, I want you to understand something. It's not your chart that's going to feel it first. It's the people who swore this metal could never run. And right now, silver is flirting with that line after printing around $79 and ripping higher like the market just found a weak spot and put its thumb straight into it. This is one of those moments where the screen looks exciting, but the plumbing underneath the screen is where the real fight is happening. So in this video, I'm going to do two things. First, I'm going to walk you through what a real short squeeze looks like in silver without turning this into fantasy. Second, I'm going to explain what people mean when they scream COMEX default, and what would actually have to happen for something like that to become more than a comment section word. Because if we break 80 tonight, a lot of people are going to celebrate. Us and a lot of other people are going to quietly get margin calls that change their month. Part 1. Why $80 is not just a number. Let's be honest. $80 isn't magic. It's not a law of physics. But in markets, certain numbers become psychological cliffs, and 80 is one of those cliffs in silver because it's clean, it's round, it's obvious, and it's the kind of level where options dealers adjust risk, fast margin rules can tighten, and weak shorts suddenly stop being confident and start being forced. You know what a forced short looks like? It looks like someone who isn't buying because they want to. They're buying because the alternative is getting liquidated. They're buying because the broker is not negotiating. They're buying because the position is bleeding every minute. That's a squeeze. And silver is the kind of market where squeezes can feel violent because the paper layer can get huge, while the truly movable physical layer does not magically appear on demand. So when the price starts rising and the market senses a crowded short, the move can go from up to up fast to up stupid in a way that makes rational people do irrational things. And tonight, we are sitting right at the edge of that. Part 2. Shorts. Lost $10 billion in one day. Is that real? You've seen the headline. Shorts lose $10 billion in one day. Here's the truth. That number can be directionally right in spirit, but it's often sloppy in math because people mix different markets, different time frames, and different exposures. So let me make this simple and clean. On the COMEX, one silver futures contract represents 5,000 ounces. That means every $1 move in silver is about $5,000 per contract. So if you're short one contract and silver rises $1, you're down about $5,000. If silver rises $5, you're down about $25,000 per contract. Now multiply that across a large position. This is why silver is dangerous for shorts when it runs. But here's the key detail most people miss. When people say commercial shorts, they're usually pointing at positioning data, and that category is real. It shows that the commercial side holds a very large short position, but commercial does not automatically mean evil bank cartel. Commercial positioning can include producers, merchants, processors, users, entities hedging real business risk. Some of them may be banks, some may be refiners, some may be industrial players, some may be complex hedges that don't behave like the internet imagines. So when you hear they're losing $10 billion, you should translate it like this. If the market is positioned heavily short on the commercial side and price is jumping hard, then the mark-to-market stress could be enormous, especially when you include futures, options, and off-exchange hedges. That's the responsible version of the same idea. And here's why it matters. Even if the short position is hedged, a fast move can still trigger margin stress and funding stress. Because hedged does not mean painless. It means you might survive, but you still have to post cash right now. Part 3, the part people don't get. It's not just shorts, it's margin. Let me say it in plain words. Most market disasters don't happen because somebody was wrong. They happen because somebody was wrong at the wrong time, with the wrong amount of leverage, and the market demanded cash before they could adjust. That's why squeezes break people, not because the chart is scary, because the cash timing is scary. When silver jumps, 3 things can happen fast. Your broker increases margin requirements, your lender tightens terms, your counterparty starts asking questions that begin with, "Can you post more collateral today?" And when that starts, traders don't behave like calm investors. They behave like people trying to stop bleeding, and in silver, bleeding can be fast. Part 4. Why silver is uniquely built for chaos. Silver is not just another asset. It has 2 personalities. It trades like a precious metal when fear rises. It trades like an industrial metal when demand is real. That combination creates a special kind of squeeze fuel, because when price rises, you don't just get speculators chasing. You also get real-world buyers thinking, "I can't wait. I need supply. I need inventory. I need delivery." And when real procurement collides with paper leverage, the market can do something that looks irrational, but is actually the market discovering where the real bid is, and that's why the recent move matters. Because this isn't silver drifting up like a sleepy commodity. This is silver repricing. Part 5. Okay, but did silver really hit 79? Yes, depending on what quote you're looking at. Different feeds will show different highs. Spot, futures, CFDs, different venues, different timestamps. But the big picture is the same. Silver has surged to record territory, with mainstream outlets reporting prints in the high 70s per ounce. So the 79 handle isn't a meme, it's the market. And that sets up the real question. If we're already here, what happens when the market tests 80? Part 6. Why gaps happen in silver, especially now. People hear gap up overnight and think it's some mystical event. It's not mystical, it's microstructure. A gap happens when liquidity is thin, sellers step back, buyers keep hitting, and the next available price is simply higher. And thin liquidity is common around holiday windows, off hours, and moments when market makers widen spreads because volatility is dangerous. So a gap is the market saying there wasn't enough size offered at the old price to meet the demand. And when silver is in a squeeze mood, gaps become more common because sellers don't want to be the person standing in front of the train. Part 7. The COMEX default line. If we hit 80 tonight, the entire COMEX could default. Here's what I want you to do. Keep the urgency, but clean up the meaning. Because COMEX default gets thrown around like it means the exchange runs out of silver and closes forever. That's not how this system is built. COMEX futures are cleared through a clearinghouse structure with layers of protection, margin, and default management procedures. So, what would default really mean in practice? It would not mean silver disappeared. It would mean something like a clearing member fails to meet obligations or a large participant fails to meet margin, and the clearinghouse has to step in and manage that failure. That's the grown-up version. And the key point is this: a clearinghouse does not just shrug, it has a playbook. It can liquidate positions, it can hedge, it can run auctions, it can use a financial safeguards waterfall. So when someone says COMEX default, what you should actually ask is, are we seeing signs of clearing stress? Or are we just seeing a violent price move? Because violent price does not automatically equal a system failure. But violent price can expose weak hands. Part 8. What would have to happen for real system stress? If you want to watch this intelligently, here's the scoreboard. Not predictions, signals. Signal 1. Margin changes and risk tightening. If margins climb quickly, leverage gets squeezed. That forces liquidation. That creates forced buying to cover shorts. Signal 2. Delivery pressure. If more longs stand for delivery than the market expects, that increases the demand for deliverable supply. Signal 3. Warehouse behavior. Look for the story of movement. What's registered versus eligible. What's being moved. What's being converted. Signal 4. Spreads that won't calm down. When near-term pricing stays elevated versus later months, that can signal immediate tightness. Signal 5. Paper price up, plus physical tight at the same time. This is the key cocktail. If the screen is screaming and the physical market is not relaxed, the squeeze narrative has more oxygen. Now, do you see what I did? I didn't say it will default. I said if stress is real, you will see it in the plumbing. That's the only way to talk about this like a serious person. Part 9. Who are the commercial shorts? Really? Let's clear up the biggest misunderstanding on the internet. People hear commercial shorts and picture a villain. But positioning categories aren't comic books. Commercials often short because they hedge. A producer might short to lock in revenue. A refiner might short to manage inventory exposure. An industrial user might short as part of a structured procurement hedge. So why do people still focus on commercial shorts? Because regardless of motive, large short positioning can become a problem when price moves too fast. Not because the short was wrong in theory, but because fast moves create cash pressure. And cash pressure forces behavior, and forced behavior is what squeezes are made of. Part 10. Why the market loves to break 80 at night. Here's a pattern you've probably noticed. The nastiest moves often happen when people aren't fully watching. Overnight sessions, thin liquidity, fewer market makers willing to stand in. And the reason is simple. In thin hours, price can travel farther with less resistance. So when you ask, could we break 80 tonight? The honest answer is, it's possible because the market is already in extreme territory and thin sessions make extreme prints easier, but possible does not mean guaranteed. It means the setup is there. Part 11. The real battle is not retail. It's risk desks. Let me give you a mental picture. Retail buys silver like they buy a story. Risk desks manage silver like they manage a bomb. When volatility spikes, risk desks ask questions like, how much exposure do we have across futures and options? What happens if we gap $3 higher? Who do we face on the other side of this trade? How quickly can we reduce risk without moving the market against ourselves? And when those questions start, the market can become reflexive. Price rises, risk desks reduce shorts, buying increases, price rises more. That's the loop. That's how squeezes feed themselves. Part 12. So are banks suppressing silver? Let me be careful here, because words matter. It's easy to say suppression because it feels like a clean story, but markets are messier than villains and heroes. What we can say, grounded in reality, is large entities hedge and trade silver. Some of those entities are financial institutions. Silver has a long history of crowded positioning on different sides at different times, and when price breaks into record territory quickly, whoever is short can get squeezed regardless of motive. That's enough to explain the squeeze mechanics without inventing secret meetings. So if you want the honest, hard version, this move does not require a conspiracy to be dangerous. All it requires is leverage and a crowded trade. Part 13. Why this move feels different. Let me tell you why people are more emotional about this run. Because silver isn't creeping from 30 to 35. It's exploding into levels that force the entire world to re-anchor what expensive means. And when that happens, shorts who anchored to the old world get punished. Longs who waited for a pullback get left behind, and the middle of the market starts doing something strange. It stops debating and starts reacting. That's the shift. Debate becomes reaction, and reaction is where accidents happen. Part 14. If 80 breaks, here's what the next hours can feel like. I'm going to describe a scenario, not a prophecy. If 80 breaks in a thin window, here's what can happen. You don't get a slow climb. You get prints, 79.80, 79.90, 80.10, 80.30. And the reason you see that kind of move is simple. Sellers step back, buyers keep hitting, stops trigger, dealers hedge, and suddenly the market is moving because the market is moving. That's when headlines start chasing price instead of explaining it. That's when people feel like they woke up in a different world. And that's why you have to treat this moment with respect. Part 15, the 10 billion story. Here's the clean way to say it. If you want to say it in a way that won't embarrass you later, say it like this. Silver's jump into the high 70s creates massive mark-to-market stress for short exposure across futures and options. Depending on the size and structure of that exposure, losses can run into the billions during sharp up moves. That's the real statement. It's strong, it's scary, and it doesn't rely on a perfect meme number. Part 16. What to watch right now. The 5-light dashboard. If you're watching tonight, don't watch like a gambler. Watch like a detective. Light 1. Does price hold above 79, or does it snap back hard? A hard snapback doesn't kill a bull trend, but it does tell you liquidity is fragile. Light 2. Does the market keep printing higher highs without resting? That's squeeze behavior. Light 3. Do we see volatility spikes that feel uncontrolled? Uncontrolled volatility forces risk reduction, forced buying for shorts. Light 4. Do we see signs of tightening terms and higher margin chatter? That's where leverage gets strangled. Light 5. Does the story move from price to availability? If availability talk spreads, premiums, delays, allocation language, then this becomes more than a chart story. That's your scoreboard. Part 17. A reality check for everybody watching this. I'm going to say something that will annoy both sides. If you're long, don't let euphoria make you stupid. Extreme markets punish arrogance too. If you're short, don't let pride make you stubborn. The market doesn't care how smart your thesis is. And if you're new, do not confuse a squeeze with a safe investment. Squeezes are exciting. They're also the easiest place on earth to get wrecked, because you enter emotionally and exit late. So breathe. Part 18. What COMEX default would look like on your screen. If something truly abnormal were happening at the system level, you wouldn't just see a big candle. You'd see a different vibe. Unusually aggressive risk controls, talk of emergency measures, disruptions in normal settlement behavior, a scramble for immediate liquidity and related funding markets, and a lot of sudden, we're adjusting our policies language. That's what real stress looks like. Real stress is administrative. It's not a villain laughing. It's a memo. Part 19. The clean takeaway. Here's the core message of this video. Silver hitting 79 is not just a price milestone, it's a stress test. It tests shorts, it tests leverage, it tests the ability of the market to absorb demand without breaking. And 80 is the next obvious test point. Could 80 break tonight? Yes, it's possible, because we are already in record territory and the market is volatile. Does 80 automatically mean COMEX default? No. But does 80 increase the chance of forced covering and violent moves? Absolutely. So don't watch this like a kid watching fireworks. Watch it like a grown-up watching a crowded exit door, because that's what squeezes are. A crowd trying to leave all at once. Part 20, Close, CTA. So here's my question to you. Do you think this is a clean breakout into a new era? Or do you think this is a squeeze that burns out once the forced buying finishes? And if we tag 80 tonight, do you think it holds? Or do you think we get the nastiest shakeout candle of the year? Drop your take in the comments. And if you want part 2, where I map the real confirmation signals, what tightness looks like beyond the chart, and the difference between price excitement and system stress, hit like, subscribe, and I'll see you in the next one. Because in this market, the only thing that matters is what settles.